Worried about April? Heard tax is going to cripple your business? Well, watch on. As a business accountant, my team and I spend all day long helping business owners on their journey. And perhaps unsurprisingly, we've had a lot of chats with clients about the tax changes now in force from April. Now, if you've kept an eye on the news over the past few months, you will have seen much talk of doom and gloom in the business world, particularly around changes that are coming into force in April. Many of these changes were a result of this black hole autumn budget announcements at the back of end of 2024. Now, we've done another video detailing that in more detail, so if you're interested, go and have a look at that. So in this video, I thought it would be good to give a recap on those changes and some thoughts on how they might affect your business. But before we get into this, if you like these type of videos, make sure to click the subscribe button and the bell below so you get notified whenever we release more videos just like this one. So let's recap the main changes that owners are worried about and hopefully give you some practical tips on dealing with them. Now, some of the changes just won't affect you, but near the end of the video, I talk about the fact no matter what your situation is in business, you will have some challenges from this April, and I'll give you some tips on how to deal with those. So be sure to watch all the way through so we can cover that near the end. Now, the first change to recap is this change to employers' national insurance. This national insurance is the extra tax that employers have to pay to the government every time they pay their teams or at certain levels when they pay themselves as directors. Now, as a reminder, this is like an extra cost on top of the wages to the business. It's a bit like employers' pension contributions. When you look at the total cost of employing somebody, you're going to add these on top. So it is quite a chunky part of the total cost of employing somebody. Now, this national insurance bill has increased from 13.8% where it applies to 15%. Now, that doesn't sound that bad, right? The problem is, coupled with this, the thresholds at which you start paying that national insurance has been lowered. So it used to be £9,100 a year that you could earn before paying this national insurance. It's a mere £5,000 now, and that is a big deal. Now, there is some offset to this in that if your business qualifies for something known as employer's allowance, that's if, this has gone up considerably. So if you want to recap on what employer's allowance is, we've done another video on that and it will dive in deep detail on it. But this allowance is going to be raised from £5,000 to £10,500 a year. Now, reminder, this allowance is the thing that allows you to reduce your employer's NI bill. So you'll be able to reduce that first £10,500 if you qualify by this amount. Now, for most small businesses, they're going to qualify if there's more than one of you on the payroll and they're paid at a certain level, but do check out the other video for the actual details for that set criteria. But just know that in general, if there's a couple of you on the payroll, there's a good chance that you're going to qualify. And with this in mind, you might not be affected at all because of this rise in this limit, or only in a small way. So we've seen some scenarios, as you can imagine, we've been chucking this out on spreadsheets, where you can actually be slightly better off. The only way to know, though, is to run those numbers. For directors of limited companies taking a small tax efficient salary, which is pretty much the norm, this will likely result in that you're now going to pay some employer's national insurance. You might have already been, but if eligible, that employer's allowance is going to cover some or all of it. But if you're not eligible, you're going to see a hike in that national insurance. It is going to cost quite a few £100 more. It's not likely to change the fact, actually, that most directors will still take a salary around the level of the personal allowance, which is about 12.5k a year, but will do another video on that for sure, detailing the kind of the best salaries to be running in 25, 26. So run the numbers here, because if you employ multiple people, there are actually several scenarios where it's an absolute nightmare situation. It just depends on where you are. So like, for example, at the time of recording this video, my team's about 40 strong, and I can tell you it's a very, very costly April. Now, couple this with the fact that the minimum wages have gone up. They've been hiked quite substantially. And as a recap, those new rates from April are that under 18s and apprentices are going to £7.55 per hour, which is plus 18%, give or take. And then you've got 18 to 20-year-olds going to £10 an hour. That's about 16, just over 16%. And then your 21 and plus year olds are going to 12.21 an hour, which is about 6 and a bit percent. So it's quite chunky. So while the rises in general, you think, okay, they're chunky on their own, the impact comes with how small businesses react to those hourly rates that are above the minimums. So if you imagine the gap between the next pay band, so you've got somebody here that's on the minimums, and then you might have somebody with a bit more responsibility a bit further up, and it causes that challenge up the pay scale. So you're not start just raising the minimum because you want to keep that fairness between sort of responsibility and pay, you're likely then to start having to adjust these other brackets. So it's a knock-on effect. So when you factor in the increase in the employer's national insurance and the fact you're going to be paying it on employees far lower than you would have done, and the knock-on effect to these pay bands, it's going to be a substantial extra cost for many small businesses. So the tip to work out here is the impact, and then just seek some help to do it if you're not confident, because obviously not everybody wants to be sitting in spreadsheets working out when the NI hits, what percentages is and everything else, but you can do some basic maths and figure out. And I think where it can be a large rise for many businesses, we're definitely seeing it in a lot of scenarios, knowing this as early on in the tax year as possible is going to give you the most time to react and do something about it. And that's the challenge, because most people don't look at it until it's too late. So that's the tip, go and work it out. Now, next on the list was business rates. Now, for some of you, if you've got a premises, you're used to business rates. Some will pay none, some will pay loads. But particularly if you're in retail, hospitality and leisure, you will most likely have seen an increase in your business rates. And this is due to the fact that an existing relief that the government had in place has now been reduced. It's still there, but it's a much lower level. So the bills are now out. I've seen a few of them on clients' books, so be sure to keep an eye out for yours. But the other reason I wanted to mention this, apart from the actual cost and keeping an eye out for the bill, is just to make sure that you keep an eye out for scams in here, because there's a lot of scams involving claiming to reduce business rates. They're mixed in with legitimate businesses. So just be careful who you get involved with. Scams aside, just make sure that you're having a look at those bills early, and again, planning whether you need to react, and we'll talk about that a bit later in the video. Now, the next kind of bad news reminder back from the budget, and it was hidden in the document, was that those businesses who are looking to buy kind of what I call a monster truck, so a double cab pickup as it's known in the tax world, or a crew cab as most people in the industry would refer to it. If you're looking to buy one of those things for your business, from April, these are no longer taxed as a van, which has some very, very negative tax consequences, particularly if you've got a limited company. It's that bad, actually, that you might now consider not buying them at all in the company if you're a limited company. So you've got to have a look. They'll effectively be taxed as cars, which means if they're available to you privately, and by available, that can mean just like on your drive, which for a lot of small business owners is going to be the case, then you'll end up with a big tax bill every year because they tax it as what's known as a benefit in kind. And even if that was the case, if it classed as a van previously, that benefit was quite small. This time, it's a big deal. And then on top of that, the upfront tax relief is also changing for the worse. So instead of being claimable in the first year to offset against your profits in full and then reduce that tax bill quite substantially, in most scenarios, it's now going to be spread very slowly over multiple years. Now, you might be thinking, well, I've already got one in the business. What's the options? Well, you're actually okay until either your lease expires if it's on lease or April 2029. There isn't really a big tip here. It's more a reminder to kind of understand the tax consequences if you're looking to buy that vehicle for the business, particularly if you're a limited company. And if you're not a limited company, you still want to think about what's the tax relief, because honestly, having the difference between having that crew cab and not might make a massive difference to how it's treated. So really understand that. Now, the last two changes were also quite niche. The first one being the fact that tax on what I call kind of the big stuff is going up. So in the autumn budget of 2024, it was announced that the capital gains rates would rise. That's quite a mouthful to say, isn't it? And as a reminder, capital gains tax is the tax you pay when you sell or kind of dispose, as it's known in the tax world, in some other way. So maybe you give it away or you transfer it somewhere, whatever the case. But most scenarios for you, you're going to sell items, sell things such as like rental properties, shares, crypto. You pay capital gains on it if you made a profit. Now, the tax rate you pay on these items has always been less than income tax rates for other types of earnings, such as like your day job, if you're self-employed, those kind of things, they're taxed at income tax rates. These bigger items, when you sell them, capital gains tax rates, and they're lower. Now, the rate you paid was based on the profit you made when you disposed of that item. So you sort of what you sold it for less kind of what you bought it for originally, and your other income in the year. It's a bit of a complex calculation, but they kind of stack your income and the profit on top of each other and you pay a rate. Sometimes it's almost a blended rate. Now, the changes mean that the rates that apply to most of those items other than residential property have gone up. Now, this brings them in line with the same rates you would have paid actually if you got rid of like a residential property buy to let you had or something like that. So these rates have been around, but now everything are going to be those rates. Again, actually on this one, you can't do much about it. It's more just reminding you that these things exist at the moment. They're in play. They didn't give us any chance to react to this. So they are there now if you dispose of something. Now, the final niche change was extra tax when you come to sell your business. I mean, I say it's niche, but actually I've already had multiple conversations already in 2025 around people selling the businesses. There's a lot of activity in the buying and selling world at the moment. So it might not be as niche as maybe I'm thinking it is. But if you're looking to sell your business, a popular tax relief was known as business asset disposal. disposal relief. It was previously called entrepreneurs relief, which made far more sense. But anyway, that's what they renamed it. This is a very, very attractive tax rate at 10% on the first £1 million profit. Now, this has changed right now from April to 14%, so jumped from 10 to 14%. But it rises again in April 2026 to 18%. So it's still a good rate, but it's not great. It's obviously not 10%. So the tip here is if you are looking to sell, doing so before April 2026 will save a decent amount of tax, so a good 4%. Now, on top of this, just as a reminder, if you are looking to do things like business asset disposal relief, there's a few limited things you might be able to do in the deal generally to mitigate tax, but you also have to structure it in a way that allows for that entrepreneurs relief or business asset disposal relief to be claimed. So always check with a professional on this. It's likely to be a once in a lifetime deal for you. Not for some entrepreneurs, maybe not, but for everybody else it will be. Maybe you're exiting and retiring. So definitely spend that extra money, get some help. And that's kind of most of the niche things and the main tax changes recap. So then, as we said, you might think, well, that's great, but I'm not in any of those situations or any of those categories. I don't really employ people. Why am I bothered? Well, I'm sorry to say that you won't be left out. The final result of all of this across the business world is that everything's going up. If you checked your email these past few weeks, you almost certainly will have received one of those emails that says, reasons, costs are going to go up, blah, 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 blah. We're already seeing it everywhere. You'd have seen it in your home bills, and you have at least one email from your supplier with those prices going up. I'm absolutely sure. Everyone would have seen it with like council tax and water and all the rest of it, and it's happening in the business world. And this is quite often a knock-on effect caused by the rising costs of people in the business. For a lot of businesses, they are the biggest cost, and the biggest cost has gone up substantially. So it's happening. And here lies the main challenge in that if you do nothing, it's very likely your business is going to be making less money, or worst case, losing money from now. So let's talk about an action plan for dealing with some of these things, because one of the biggest areas we see in small businesses, and one of the key reasons small businesses fail, is that they just fail to react to this kind of cost creep. They just don't do anything, and before they know it, they're struggling. So let's have a look. And I think there are a few key practical tasks you can look at to combat these challenges. So the first one would be to kind of assess your own business model. And if you've seen some of the content that we've put out before on this, I'm a big fan of this exercise. There's other videos we've done on kind of monitoring your model and having a look. It's just making sure that the cost creep doesn't kill you, and it's looking at, okay, well, where are we today? What are my costs? What am I likely to sell? What are my margins? And again, there's other videos done on this, and it's doing that exercise in either a spreadsheet or on paper and just working out what the effect is. Am I now 3% down because of all these costs? And is that 3% going to materially cripple me? Does my business model suddenly switch into being something that just doesn't really make any money anymore? What's happening? And I would regularly do this. It's not just this April, but I think that this exercise must be done now if you're worried about any of these things. And again, you can watch me talk in more detail on those videos. I'll link them in the description below. And just have a look at that big overall picture of the business model. Just think about, overall, what's it going to look like? And once you've done that, you might well then think, do you know what, something's got to change? And then you'll want to review your own pricing. And I know no owner likes this task. They all worry about the loss of customers or clients, but raising price is certainly a strategy you need to consider. I mean, I hate it. Everybody hates it. I think you're all worried about it. No one likes doing it. Everyone thinks I want to stay as competitive as I can, and price is obviously one of those areas. But in the small business world, as I said before, slow reaction to cost pressures is the key reason we see, the most common reason we see that existing businesses start to become unprofitable. They start to lack resources. They can't then deliver on as well as they could. Service levels go down, customers fail. And it's like this slow kind of deterioration. So you really do need to have enough profit in the business to kind of sort it out. And I think there's many gurus and people that tell you this idea that, profit solves many of your problems, if not all of them. And it is true in the small business world as well as in any business. So you can watch more detailed videos we've talked about on a pricing under pressure video. And again, I'll link it in the description, or maybe in and around here, who knows, where we talk about maybe how you can look at those prices and what you might do. It doesn't necessarily have to be all of them, and some best practices we've seen from clients where they've communicated this well and haven't had much of a kickback. Because in all honesty, if you've not heard me talk about pricing before, normally when you up prices, it's nowhere near as disastrous as you think it is in your head. It's actually more of a practical and admin challenge a lot of the time. But go away, have a look, and look at the pricing as well once you've looked at your model. And as with these other tips, you can do a lot of this maths in your spreadsheet. What's the impact of these price rises? How will it help with that model that I played around with at step one? And then again, if you need help, sometimes you might want help from a friend or another person in business or a professional or an accountant. If you need help calculating these things, do it, because they are a very important thing. If you can't figure out how your business model should look and get some oversight on it, you're going to be struggling to make that business work long term. Now then, if you were in that place of selling your business, then the easiest tip is consider doing it this year to keep the bill as low as possible. As we said, you're going to save 4%. So action point for you there is absolutely look to do it before April 2026. Just bear in mind, these deals always take a lot longer to do than you think. You know, they're a good 6 months normally to actually get them across, even for some of the smallest businesses, because by the time you've got legal people involved, documents back and forth, accountants, and all the rest of it, does add some time to the deal. So just make sure you give it plenty of time and discuss as early as you can with an advisor about how you structure that deal to make sure that it's possible to get this business asset disposal relief, because you'd be amazed the amount of times that the wrong structure or just the wrong situation means that it can't be claimed. And sometimes actually the best time to look at it is 2 years in advance for various different criteria reasons. And then the final kind of action point in the niche scenarios is if you have a double cab pickup in the business and you intend to hold it past 2029, research what the impact of that's going to be. What are your options? And have a look at that. Obviously, as we said, if you're buying one, then you can make that assessment early. But if you've got one in the business, your action point is going to be to have some early discussions about what is the actual plan? What's it going to be? How much tax could it be? Should I get rid of it? And do that research. And obviously you can do your own research, speak to an advisor, work out if it's worth keeping in the business. And this is really, really relevant if you're a limited company, because that's where a lot of the pain is. Now, to finish off, there is some final good parting news that if you're self-employed, in general, if you're self-employed, so not limited, there appears to be a lot of panic over rises. Obviously, as we said, you can't avoid those cost pressures, but not much is actually changing in terms of tax if you don't have a team. So again, if you've not got a team, you're not in any of those other scenarios and you're self-employed, the tax is still pretty good actually on that. So that is good news. It's not moving. It's just that cost pressure issue. Now, with limited companies, it's not all doom and gloom either, because if you're without a team, they're fairly stable in the tax world. Outside of the changes we've talked about in the video, not much is actually changing. And Labour did release that roadmap that told us that this is what we're doing with corporation tax. So we kind of know there's a bit of stability. So there you go. Some good news. So do check those action points out and make sure that you're as prepared as you can going into this tax year. Now, if you've enjoyed this video, please do click the subscribe button and share this with anybody you think needs to know this information. And we'll see you on the next one.